Good morning and welcome to the ADS Securities Markets Update. The first day of the week was very interesting and very volatile across the board. The global equities basically was crashing throughout the day from Asia, the Middle East, Europe and also the US. And this is again called one of the days of Black Mondays, as if we are in October of 2008 all over again. The main reason behind this crash was yesterday because of the People's Bank of China. Basically, we've seen a major decline in all the equities, including in the US. We've seen Dow Jones declining by more than 1,000 points in pre-market. We've seen also S&P, Shanghai Composite Index in the early morning hours also lost more than 6.5%, losing the 3,000 points of support area for the first time in almost 8 months. We've seen also most of the major equities in Europe and also in Asia declining across the board, including also here in the Middle East. Again, the crash, or the reason behind this crash was because of the People's Bank of China, which did not intervene over the weekend as many expected. The traders were hoping for a reserve requirement ratio rate cut by the People's Bank of China over the weekend. However, the People's Bank of China remained silent throughout the weekend, with some reports of a possible intervention to flood the market with more or with new liquidity. In addition to that, of course, this crash in equities led to a notable impact on the currencies market. The US dollar declined sharply across the board, and the price action for the US dollar yesterday, it seems that as if the Federal Reserve cuts the rate instead of raising it, or as if the Federal Reserve launched another round of QE, and that's why we've seen sharp declines in the US dollar index, declining below 93 or 93 barrier and continue to decline to 92.70s. However, before rebounding again during the Asian session and the US session yesterday. But at the same time, we've seen all of the currencies gaining across the board, or against the US dollar at least, except two currencies, which is basically the Aussie and the Kiwi, because they are commodities related. But looking into some technicals, especially the US dollar index, which basically broke through many support areas yesterday, declining below 200, the 200-day moving average, which stands at 94.73, and closed the day well below that support, which deepened our bearish outlook for the time being. However, a short-term retracement or recovery could be seen the coming days or the coming hours, at least toward that broken trend line, and also any upside move should be limited below that MA at 94.73 before the downside trend resumes. On the downside view, we have the 93.13, which is the next immediate support, which should be watched very careful, as a breakthrough that support may clear the way for further declines ahead. Looking into also more technicals, which is we'll start with the euro, which is the king of the day yesterday, leading the currencies across the board with more than 3% of gains, touching 1.17 up from 1.1350s basically earlier yesterday's morning. And this breakout, also the breakout yesterday's above the key level, which was around 15, increases or strengthen the bullish outlook on the short term. A short term correction also on the downside could be seen toward 1460s, which basically also stands at the same level of yesterday's breakout, could be seen. However, it's likely to be limited before the upside trend resumes. The technical indicators and technical oscillators also remain positive on most of the time frames, which also continue to show more bullish outlook on the short and the medium term at the same time. A break above 1.17 in the coming days and the coming hours may clear the way toward or for further gains above 1.18. The dollar yen also yesterday showed notable declines yesterday, or crashing or declining to as low as 16.18 before the US session opening bell, which basically had some sort of a recovery. However, at the same time, some of these were recovered during the US session at the end of the day, but closing the day around 1840. But at the same time, the day yesterday were very bearish, closing the day well below its 200-day moving average and all of the recent moving averages, which is the 50, the 100, and also the 200-day moving average. And this is the first daily close, at least below the 200-day moving average, since July of last year, which also continues to deepen, you might say, deepen the bearish outlook for the time being. And we might even retest these levels again, which is the 18 and also the 16 in the coming days. The British pound again, which remains our favorite. Yes, the British pound, which basically remains our favorite currency for the time being, despite the fact that it's still lagging compared to other currencies. However, the British pound also broke out from its recent tight range, trading for the past since mid of July of this year, but a break above 57.20s and continued to rise further, reaching as high 57.90s and remain stable around that support, around that resistance until this support is released. Yesterday's close also is a clear breakout, with strengthening our bullish outlook for the time being, at least on the short term. And the next immediate resistance right now stands at 58.15, which should be watched very careful. Could be seen during the day, but a breakout or a break above that resistance is likely to clear the way for further gains ahead toward the next resistance area, which stand at least 58.80. Gold and silver also yesterday lagged since the end of last week, as most commodities kept on declining. We've seen yesterday West Texas and the Brent crude, which saw more and more declines and more lows and new lows. West Texas crude declined yesterday to as low as $37.73, and Brent crude also fell toward $42.23, which keeps the fears increasing toward or over a global deflation. In the meantime, with all of this movement yesterday in the market, the U.S. Fed Fund futures declined sharply yesterday to only a chance of 28% to raise rates in September, which basically was around 40% last week, or at least on Friday. Even December's rate hike probability right now is at 48%, down from 60% last week. And this is likely to weigh on the US dollar in the next few days as the uncertainty mood continues in the coming days. Therefore, traders need to be very cautious. As for today, we will be waiting a few fundamentals today throughout the day, including or from European session and the U.S. session, which basically throughout the day, including the employment level in Switzerland, with also the German IFO business climate. In addition to, or in the U.S., we'll be waiting for the house price index, the U.S. flash services PMI, the CB consumer confidence, in addition to the new home sales and the Richmond Fed manufacturing index. And most of these figures are likely or expected to have a notable impact on the market. The estimates are positive, but any surprise to the downside is likely to have a notable impact on the market. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching. I'll see you once again tomorrow.